Chapter 6, Engineering Economics, Thomas E. Hulbert, Professional Engineer Introduction. Engineering design are subject to many levels of review. The design must meet with the physical needs of the project, must utilize the appropriate materials, must result in a structurally sound product, must be aesthetically pleasing, must be economically feasible. If an engineering review indicates that the project meets all of the other criteria, the project must then be evaluated in financial terms. Beyond simple with the understanding of the cost of material, the engineer must have the firm grasp of the labor, maintenance, insurance, interest, depreciation, costs, and charges. Material in this chapter should be served with a general review of the fundamentals engineering examination. Since you will be taking this examination with an open copy of the National Council with Examiners Engineering Survey Reference Handbook, topics of the chapter will follow the book. Be sure to review the material before you attempt to solve all the problems at the end of the chapter. If you feel you need more in-depth instruction, refer to the textbook on subject engineering economics for helpful resources. References listed in section 614. Alright, 1. Fundamental concepts. 2. Nomenclature definitions. 3. Nominal effective non-annual compound interest rates. 4 cash flow diagram. 6.5 interest formula tables. 6.6 financial metrics, operating statements, balance sheets. 7 depreciation methods. 8 bonds. 9 benefit cost analysis. 10 capitalized costs. 11 inflation. 12 method of analysis. 13 the factors in the factor tables. 6.14 references. 6.1 Fundamental concepts. Engineering economics is based on the two fundamental concepts. Equivalency, with the money increase the value over the time of the future value. Equivalence referred to the fact that the various cost benefit statement differing from the cash flow patterns may actually be equivalent to most necessary equal funds. Future value refers to the fact that the money earning interest, thus increasing in value over the time. Engineering economic calculations time is assumed to be 1 year, yes, unless otherwise specified by the calculation considered to be have been end of the year unless otherwise stated. Interest of the difference between the ending money amount of money, future value, initial amount of money, present value with the interest rate with a given period would ratio of the difference divided by the present value. Their simple illustration equivalents considered with the following two alternatives. Alternative A, receive $100 today. Alternative B, receive $110 1 year from today. Choice between A and B not clearly evident. If you choose B, indicate with a minimum acceptable rate of return of 10% per year. If you choose A, your rate of return is indefinite and may be greater or less than 10%. Some individuals may be indifferent toward the choice between A and B. For them, A and B are equally attractive, equivalent, even though the two alternatives involve different amounts of money, but at different times may not be in financial analysis proved to be equal. Another example, equivalency exchange for the U.S. dollar and other currencies in exchange only with the exchange rate itself is considered not the buying power of either currency. The amount of foreign currency received is equivalent to the amount of the U.S. dollars, but is not necessarily equal to the purchasing power. 6.2 Nomenclature definition. Following symbols released for the National Council Engineering Examination Series Fundamental Engineering Reference Handbook. Those for the Engineer Economics Problem Text. So the explanation, some symbols have been explained with greater clarity. A. Uniform amount per interested period. B. Benefits saving derived from the public benefits. Book value. BV. Remaining value after the depreciation charge for each year. C. Initial value of present worth of all costs of the sum of the cost of the public work projects. C. B. Above. Lowercase d. Combined interest rate per interested period. D. Depreciation in a year. F. Future worth value and amount. Lowercase f. The general inflation rate per interested period treated the same as I. G. A uniform graded amount per interest period. I. Interest rate per interest period, yet unless otherwise stated, i.e. interest effective with interest rate annual with the engineering economic studies unless otherwise stated. M. Number of compound periods per year. N. Number of compound periods expected life asset usual years. P. Present worth value and amount. R. Nominal annual interest rate per annum. SN. Expected salvage value in the year N. 6.3 Nominal effect with non-annual compound interest rates. Base engineering economic calculations is the same as you with the financial institution and the calculation interest of the time value of money. Refer to the figure of the top of the page 151. At the end of the first year, there will be $1 times $1 times I. At the end of the second year, there will be $1 times I squared, 1 plus 1 I squared. Therefore, interest rates of I $1 today equivalent to $1 plus $1 plus interest rates to the end and received an n number of years from the today at the end of the period. Many financial transactions, annual nominal interest rates are specified by the compound process. Actual occurs several times throughout the year. For example, the nominal interest rate of 12% per year is compound semi-annual. The effect is to have paid 6% interest rate per 6 months for 2 6-month periods. If the $1,000 invested with these conditions, it will become 1,000 times 1.06 squared, or $1,123.60. Effective interest rate of 1,000 or $101.06 squared minus 1.2356 or 12.36%. Note delays are nominally expressed in years. The nominal interest of the rate per year over the compound M times per year effective of the interest rate, or I, and effective plus equals 1 plus the nominal interest rate returned over the number of years times the number of years minus I. Second example, suppose a financial company charges 1.5% per month compound monthly the nominal interest of 1.5% at 12 times 12 is 18%, but the effective interest rate is actually at 1.015 to the 12 times 1, or 19.56 interest rate. 6.4 Cash flow diagrams. Flow of money is shown with a diagram known with the cash flow diagram. Figure 6.1 money at the present time is or time 0 of the present value with the designated with as P. Uniform annual receipts of the disbursement designated as A, and the money in the future of the future value of the designated F. Setting up the problems. Figure 6.2 illustrates with the gradient linear increase amount of the money starting at time 0 with the gradient line 0 with the cash flow diagrams represented as follows. Figure 6.1 shows cash flow diagram. 6.2 shows the gradient. 6.5 Interest Formula and Table. The National Council of the Engineering Exam Series Field Fundamental Engineering Reference Handbook includes 8 commonly used factors along with the original names, current expression symbols. For each factor, the algebraic formula for each, you can solve the problems either by searching a table by using a calculator with the formulas, complete the set of the factor table to provide with the exam, and include at the end of the chapter portion of factor table at 8% interest in the shown below. Left column represents the time period, generally in year, of the 4 factors. Their respective values are shown in the matrix table. The favorite factor 1 factor table for interest rate at 8%. Present value and future value, present value, and disbursement designated present value times G, and future value times present over present value. Or 6.6 Financial metrics, operating statements, and balance sheets. Evaluating engineering design, financial evaluations aside for the decision before making the final decision. Continue to complete with the project, control of the financial managers, accounting. Develop and use many financial report statements that assess financial health of the enterprise. 2 statements that relate to the evaluation engineering design or after traditional engineering economic analysis are completed are operating statements and balance sheets. Accounting and engineering economics. The operating profits loss of the statement is an itemized list of the income or sales, usually a month, of the corresponding list expense for the tabulated with the calculated gross fit, subtract cost, labor, material, selling, material administrative expense for the depreciation see below for the sales of the period after deducting state of the federal tax the result of the profit after the tax net profits for the distributed to the stakeholder employees retained earnings see balance sheet with the portion of profit going to the retained earnings provided funds acquiring assets such as the purchase of capital equipment. The depreciation charge expense for the systematic write-off of the assessed overtime of the system is passed for the Congress Administrative of the IRS. The capital asset is purchased and paid for, then a charge usually monthly on a P&L as an expense for the modified accelerated cost review system or marks. See section 6.7. Retain earnings showing the balance sheet with the balance sheet itemized listing all of the net asset of the company, but this is what the company owns. The other side of all the liabilities which are owned by the company retain earnings are portion of the owner's equity with the fundamental or accounting equation. Assets equal liabilities plus owner's equity. Increase of the related earnings can result with the opportunity capital investment. Increasing asset with the liabilities well with the owner's equity while maintaining a balance and above equation. The 2 statements for the other financial data give the measure of financial growth and stability of the company with a calculation comparison with the number of the ratio that can be found with the accounting books but are beyond the knowledge required for the exam. Or 6-7, the depreciation method. The value of the client exists excess of the heavy equipment and machinery of the tools, one of the many of the factors into the analysis of the economic feasibility of the project is likely similar to the assets were placed in service years ago and will have already been partly or even fully depreciated. You must have the depreciation method used for your client because of the challenge defended with the analysis of the depreciation method employed for the chart beyond start must be continued. In an accounting world, the depreciation expense for the previously stated the systematic write-off of the asset over time of the internal revenue service code with a specifically available system, the depreciation lifelines allotted for the rare step of the physical asset of the taxpayer may choose for among limited number of the optional methods. The after-tax analysis due for the rate of the returns if the depreciation charges are not linear, except in straight-line depreciation, you must calculate their impact on the rate of return calculation. Depreciation charges most familiar depreciation methods in order to take problems in the fundamental exam. The first is straight line depreciation. Straight line is equal to, or depreciation is equal to the first cost minus the salvage value over the total number of years, same for every year. Modified ACRS have been effective within 1986 and second method used. See table below. The modified accelerated cost review system table. The above is part of the modified accounting cost reviews. Modified cost review system depreciation. Note that the depreciation factor for 1 year following with the number of the years write off. For example, 5-year asset with written off for 6 years. Modified accounting cost recovery system assumed with the mid-year convention were assets charged over the beginning of the July 1st, resulting in 1.5 year decided charge for the end plus 1 year. In this example, the year 6 depreciation is provided for the 5th year asset, which 1/2 of the 5th year percent example, the type of equipment asset for the written off of the different number of the years are listed below. 5-year property, automobiles, computer for the peripheral equipment, the property used in the research experimentation, 7-year property, often furniture and fixtures, 15-year property, land improvements, roads, pipelines, power production, phone distribution equipment, 27.5-year residential rental property, 39-year property, non-residential real estate, including home office. Note the value of the land may be depreciated. There's an alternative to the modified accounting cost review system. Depreciation system known as ADS. Depreciation is deducted as generally longer periods under the normal modified accounting cost recovery system using straight line method described above. 6.8. Bonds. Bonds are similar to stocks in their value. The prices fluctuate up and down with the market. Bonds, however, they're somewhat with the security that they have par purchase value price, which is guaranteed, and the bonds are held with the maturity with a return with the security with the interest is set with an unvarying rate with the bond owner with the earns as long as he or she has the bond. Once the bond has issued, the price of the free will fluctuate with the bond yield. The influence of the bond price. The bond yield is computed with the basic of comparison of the annual interest to the current cost. Used to set up cash flow diagrams to solve the problems concerning the bond yields, and bonds are often issued with financial construction projects. The interest paid out with the bondholders but must be figured in the cost of project. 6.9. Benefit cost analysis. Simple benefit cost analysis. Benefit B project should be exceeded the estimated cost. C, with the calculation based on the ratio benefit, the cost of the incremental benefits of the corresponding with the increment cost of the higher ratio, the greater than 1.0 or the larger part of the difference, more attractive project will be government, nonprofit, agency funding. The project benefit cost analysis give the only situation where no taxes are involved, with a rough estimate is adequate. 6.10. Capitalized cost. Capitalized cost, annualized expenditure for the maintenance, replacement, operating costs necessary to keep an asset with the service of the perpetuate and forever. With the calculated capital cost is determined if the annual cost divided by the interest rate. Capital cost equals present sum equal to annual cost over the interest rate. 6.11. Inflation. Economic analysis. You can treat inflation simply as another interest rate to account the inflation deflate of the future dollar with the general inflation rate. Alternatively, you can use the inflated interest rate, with which includes both influences of the inflation and inflation-free interest rate in your calculations. 6.12. Method of analysis. Present worth of analysis when comparing alternatives to have same lives. For each alternative, start with initial investment at time 0 with a negative value. Add the discounted values, all revenues, alternatives, subtract the discount values, all costs for the lifetime. Select the alternative having highest net present worth. Annual worth analysis. When alternatives have different lives, convert all revenues costs there to the equivalent annual values. Add normal annual value of the revenues, positive value, then cost, negative value. Select the alternative that having the highest net annual cost. For a situation where costs dominate, one could determine the annual cost analysis. Cost assume positive revenue. If negative, then select the alternative having the lowest net annual cost. Solution technique. Rate of return analysis. When interest rates are unknown, the rate of return on investments, the interest rate that makes the total annual worth of all the revenues equal to the total amount worth of all the costs for all the cash values flows. Annual cost created by the expression value revenues minus cost to plug in the value of the interest rate in by trial and error. When the value switches from positive to negative, linear interpolated with successful factor tables to determine the interest rate and the rate of return. Rate of return incremental investment. Consider alternative design production methods to solve the problem. For example, suppose you have a new machine, most of the purchase of production, particular part. 3 machines are under consideration. Calculate the return incremental added investment. 1. List alternative with a hierarchical order with a capital cost of the investment, beginning with the least costly of the alternative. Give revenues costs of each for the calculated with the rate of return and interest rate of the alternative as so much of the present worth of the alternative equal to 0 using the P over A compared with the rate of return for the present over the annual over the alternative with the minimum acceptance of the rate of the return of the enterprise. 4. Eliminate with the consideration alternative that does not meet with the minimum rate of return. 5. Other remaining alternatives compare with one of the lowest investments to one with the next higher investment. Consider the incremental or added investment with the incremental revenues for each revenue alternative to subtract the incremental investment from the incremental cost to calculate the rate of the return. Select the alternative with the yield of the highest return over the added investment. Break even analysis on the same graph. Plot the fixed of the variable cost produced for the product with the revenues generated with the sale of the product. Intersect with the total cost, sum of the fixed costs and variable A. Revenue lines with the break-even point. Profits are generated above the break-even point. Losses below. See the example 6.3 shows break-even analysis, loss, break-even point, revenues, profit, variable costs, and fixed costs over units and dollars. 6.13 factors and factor tables. Algebraic forms factored below are given in the reference manual. And 8 factors are various interest rates. Present worth of the future worth given in the future worth. Present worth at annual cost rate revenue. Future worth at annual cost revenue. Annual cost revenue given at present worth. Present worth given at gradient value. Annual cost over revenue given in the future worth given in the present worth, and annual cost given revenue given in the gradient value. And it goes into some tables. At 4%, 6%, 8%, interest rate at 10%, 12%, 18%. 6.14 reference to the material of the chapter provided with a brief overview of the engineering economic operation fundamental examination. Candidates who have not had the formal course and subject wish to review more detailed reviewing, referring to one or more of the textbooks. Engineering Economy, 13 edition, Sullivan, Wicks, and Luxhu. Prentice Hall of 2005. Principal Engineering Economic Analysis, 4th edition, White, Case, Pratt, A. Agree, John Wiley, 1998. Principal Engineering Economic, 8th edition, Grant, Leavenworth, Ireson, John Wiley, 1990. Engineering Economic Analysis, 9th edition, Newman, A. Schaumbach, LaVille, Oxford University Press, 2004. Engineering Economy, 6th edition, Blank and Tarquin, McGraw-Hill, 2004. Practice problems. And then we should be on to Chapter 7, Engineering Mechanics Statistics.